The obvious implications is if there's a trade war between the US and China, it's going to have implications on trade, which therefore weaker trade would result in weaker demand for fuels in the transportation and the maritime sector, which will put downward pressure on the oil prices, which will put downward pressure on government revenues. And in government-led economies like this in the Middle East, particularly the oil exporters, of course, that potentially could mean further fiscal consolidation, just when the governments are starting to get into a sound fiscal position. The other implication that we need to consider is if there is a trade war, it leads to higher tariffs in the US. Higher tariffs are inflationary, and therefore the Fed would be incentivized even more than it already is to quicken the pace of tightening monetary policy. So you would see higher interest rates. And again, because of the peg here in the GCC to the US, to the dollar, that would mean our interest rates would also increase. So you would have higher tariffs lead to higher inflation, higher interest rates, which would lead to slower growth because higher interest rates would be a headwind against growth, and it would have implications for interest payments, for sovereign, for corporate, and even consumer debt in this part of the world as well. In reality, the Chinese are not going to make a significant strike first. It would have to be America. There may be small-scale tit-for-tat retaliatory tariffs, but a significant strike would come from the US, and then China would respond.